So the purpose of this video and this Excel spreadsheet is to walk us through how we handle deferred tax liabilities. As you should have learned from reading Chapter 19, the issue with accounting for income taxes in our financial statements is that the income tax expense that is on the income statement is based on financial statement income. In other words, income according to GAAP. The income tax payable, the amount we pay the IRS, is based on taxable income, which is calculated using the IRS code. Well, those two sources of guidelines are not the same, and so somehow we have to deal with the differences. Deferred tax items arise because of what we call temporary differences, timing differences. It's not that we're going to be taxed on something that we won't report as financial income, it's that the timing of when those are reported is different. And so in this video, I want to walk us through deferred tax liabilities. There'll be another video that will walk us through deferred tax assets. Deferred tax liabilities, what we're going to be talking about here, come about when we recognize income for financial statement purposes before we recognize it for tax purposes. So in other words, we're going to recognize income in our financial statements in one year, but we won't be taxed on it until a future year, thereby leading to what's called a future taxable amount and subsequently a deferred tax liability. So here's the scenario we're going to walk through. We're going to assume that Mojito Company recognizes a $15,000 gross profit from installment sales for financial accounting in 2015. Now, installment sales, you probably realize, are sales wherein we're allowing the customer to pay us in installments over a period of time. But we know from an accrual-based perspective that we recognize income when we have met our performance obligation, not when we collect the cash. So we're going to recognize this $15,000 in financial income immediately in 2015. From an IRS perspective, we will recognize it as we collect it. So it will be spread over the 5-year period. So it will be taxable at $3,000 each year for the next 5 years. The company earned $10,000 additional income each year, and the tax rate is 40%. We're going to walk through several schedules that ultimately will get us to the journal entries that we will need to make. In this schedule, I've outlined for the 5-year period, 2015 through 2019, the taxable income and the financial income so that we can see the differences, and then we'll also look at the payable and the expense. So remember, in the scenario we said that we were going to assume the company earned $10,000 each year outside of the particular deferred tax item. So in 2015, under taxable income, we see $13,000, the $10,000 plus 1/5 of the $15,000 installment sale. And so as you look through the 5-year period, you see every year we're recognizing for taxable income the same dollar amount, and for the 5-year period, $65,000. The income tax payable column represents what we actually are going to have to pay to the IRS, and it is merely a calculation of the taxable income for the year times our tax rate of 40%. And so you'll see every year for the 5-year period, we're going to pay to the IRS $5,200 for a total of $26,000 over that time period. Now, the column entitled Financial Income is the income we will actually report on our income statement. In 2015, notice it's $25,000. That's the $10,000 excluding the installment sale plus 100% of the installment sale. Then the subsequent years, it will only be $10,000 a year because we will have already recognized all of the installment sale. And then our income tax expense column, this is the expense that will show up on our income statement. This is calculated by taking the financial income times the tax rate of 40%. And so in 2015, we actually have an income tax expense of $10,000. Subsequent years, only $4,000. Now, just to be clear, I want to point a couple of things out. Notice that for the 5-year period, the taxable income and the financial income are the same. In both instances, we are reporting cumulative income of $65,000. The difference is when that is reported. This emphasizes the fact that we're dealing with timing or temporary differences, not permanent differences. The same thing holds true for the amount of income tax we pay and the amount of income tax we expense. In both instances, it is $26,000. The only difference is the timing of when those things happen. Okay, so let's move over to this other worksheet and look at the calculation of our deferred tax liability. There are a couple of approaches to this, and I'll walk us through both. In the first one, we're looking at the book basis. The book basis means the financial statement basis of unearned revenue. Well, we have no unearned revenue according to the financial statement for this item because we recognized 100% of the installment sale in 2015. On the other hand, the tax basis of unearned revenue is $12,000 because we only recognized in 2015 the first installment payment in taxable income, which means there's still 4 installment payments of $3,000 each that have not been recognized for tax purposes. That means we have a cumulative timing or temporary difference of $12,000 at a tax rate of 40%. That gives us a deferred tax liability of $4,800 at the end of 2015. In other words, sometime in the future, based on what has happened as of 12/31/15, we will have to pay the IRS $4,800. Below this is an alternative approach to calculating it. What we've done here is I've identified for each year the amount of taxable installment sale that will be recognized for the 4 years subsequent to 2015. So $3,000 a year. The tax rate, of course, is 40%. That leaves us with a deferred tax liability of $1,200 for each year. So in other words, 2016 through 2019, we will have a liability to the IRS to be paid of $1,200 a year. For 4 years, you total that up. That means $4,800 is our deferred tax liability at the end of 2015. Both approaches come to the deferred tax liability the same amount, just looking at it a little differently. And there's a reason where you might need one method over the other, but we can address that later. Okay, let's look at this last spreadsheet wherein we go through an analysis to determine our journal entries for each year. Let's first look at the schedule at the top of the work paper. What I've done is for each year, I've created a reconciliation to come down to income tax expense for the year. So 2015, at the end of the year, we've got a deferred tax liability of $4,800. We just walked through that calculation. At the beginning of the year, it was zero because this whole situation arose during 2015, which means for 2015, we have a deferred tax expense of $4,800. That's the origin of this deferred tax item. The current tax expense, what we currently owe the IRS, is $5,200. That came from the income and assumption worksheet that we walked through. Our income tax expense for the year is the sum of those two, the $10,000, which if you go back to income assumptions, you'll see that also equals what we came up with there. Now, in 2016, our deferred tax liability at the end of the year has decreased by the $1,200 that we identified would be recognized in 2016. So at the end of the year, we only have a liability of $3,600. Beginning of the year, it was $4,800. Just like inventory, whatever we have at the beginning of one year is what we had at the end of the other. That means that what happened was during 2016, $1,200 of that deferred tax liability reversed. So we're going to have to recognize or pay $1,200 to the IRS that we have already recognized as expense in our financial statements. Current income tax expense, what we're paying to the IRS, remains $5,200, and that means our income tax expense for the year is only $4,000. So in other words, in 2015 we paid more, we expensed more than we paid. Now, as that reverses, we will begin to pay more than we expense. And then if you walk through 2017 through 2019, it's just the same process. Each year, we will reduce our liability by $1,200 until at the very end of the 5-year period, it's zero. Now, let's quickly look at the journal entries. They come straight off this little calculation. 12/31/15 is the originating entry. This is when the deferred tax liability is first set up. We will debit income tax expense for $10,000. That comes straight from our little schedule. We will credit deferred tax liability of $4,800, also comes from our schedule. And then income tax payable of $5,200, which we calculated. That's the amount we actually pay the IRS. Now, in subsequent years, when we begin to reverse it, notice our income tax expense is going down. Our deferred tax liability gets debited by the $1,200 because we are reducing that liability, and we all know we do that with a debit. And then the credit to income tax payable, what we have to pay the IRS, is $5,200. Now, and every year from 2016 to 2019, the entry is exactly the same, of course, because we're assuming an even payment of the $1,200 throughout the years. Okay, last item before we run out of time here. On the income statement, you see in 2015, $10,000 of expense, 2016 to 2019, $4,000, just like we calculated. But you are required to break out the deferred portion from the current portion. You can do it on the face of the income statement or in the notes. But this $10,000 of expense, $4,800 was deferred, $5,200 of it had to be paid currently. We've got to tell the readers of the financial statement that. And same thing in the subsequent years. The $4,000 expense consisted of a payment of $5,200 and an offset of a previous liability of $1,200. Okay, so let me know what questions you have, and we will continue on.